Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 22nd, 2021. Please see our disclaimer for important information. Our first chart of this week is our COVID tracker, which we show you just about every week, and the trend line continues as we've been describing to you over the last several weeks and frankly the last couple of months, that we continue to see a decline in the 7-day moving averages for both daily new positive tests as well as daily deaths. You can see on the daily death side, which is the right-hand side, that we're down somewhere close to around 1,000 per day on the tracker here. This data comes from CDC, Centers for Disease Control, as well as First Trust Advisors, our partners up in Chicago. And you can see the aggregate number of deaths continue to decline. Again, part of this is a function of vaccinations, et cetera, but you can see the aggregate numbers going down, which is pulling down that 7-day moving average. And we did kind of flatline a little bit there in the maybe the second week of March, but we continue to, we've resumed that downward trend in both categories. Here's our daily dose chart, which we've showed you. We had a little bit of a dip there, as we've described, related to adverse weather across many parts of the country last month. That trend line picked up a little bit, maybe just ever so slightly rolled over in the latest week, but the overall trend remains upward. Obviously, we'll want to look at the data next week coming out of the CDC to make sure that we're continuing an uptrend, especially since we now have a new therapy on the market, which is the JNJ vaccine. And speaking of the Johnson & Johnson vaccine, we can see here that we've now been able to administer almost 1.8 million of those as of March 17th, and about 113 million overall. So you can see Pfizer, BioNTech, and Moderna both around kind of the 54 to 57 level million doses administered now. So those are the two-shot regimen. So if you assume that that's somewhere close to around 110 million doses, that's actually 55 million vaccinations across the country. And then the J&J vaccine, of course, is a one-shot regimen. And then we've got some others that kind of fill that bucket, fill out the rest of that bucket. But the J&J is a one-shot regimen, so we're able to get to make up a lot of traction here very, very quickly. This is a chart that comes to us, data from Bloomberg, again, produced by our friends at First Trust, but it shows a COVID test performed versus positivity rate. And so as we get more people vaccinated, you would expect that frankly, the number of tests will go down. And it looks like, we've seen a little bit of downward decline with some notable spikes in the chart for daily COVID tests that are being performed, but the positivity rate looks like it's really beginning to kind of settle in here at maybe the 4% range. It's a chart from Evercore ISI that we've shown you before, and I put the arrow in here basically to say, as you ramp up the J&J vaccine, and I'm not even sure that this chart really factors into play here, that Merck will actually be producing the J&J vaccine starting roughly in June when they get their production facilities up and running to be able to do that. But essentially, by the end of May, if you add up, the three main sources of vaccines here in the U.S., that you're going to have about almost 500 million doses. And when you take into consideration the Pfizer and Moderna two-shot regimen and the J&J one-shot regimen, that is just about enough to inoculate the entire population. As we begin to filter in some of the high frequency data, I don't have the full high frequency chart to show you this week, but I do have a couple of things to show which have obviously been in the news and in many discussions lately. This is one of them, the TSA checkpoint traveler throughput data that we've seen. We had a little bit of a spike in December. We saw a lot of holiday travel, and obviously week over week. That had a change, but this data is actually year over year, so you can see relative to a year ago that at our peak, or at our trough, I should say, we were roughly about 98% below a year ago. And as you can see right now, we're, with this latest spike, and again, we had spring break and we have some reopenings in certain areas, and I'd kind of almost term it as a COVID jailbreak. People that are interested in getting back out and getting in motion, people that are vaccinated that want to go see family, that we had been settling in at that, basically that 40% below a year ago environment until really this last week or so. And then we've seen a noticeable spike. We're still below a year ago, but we're making up a lot of ground. This is data from OpenTable, and it just shows the seated diners. This is a year over year number, like we saw on the TSA checkpoint. Directionally, we see a clear turn. We had some states and some municipalities, frankly, that had some lockdowns and curbed liberties, if you will, forced shutdowns and reduced capacities and things like that towards the end of the year when we saw that resurgence in the virus. So that accounts for that dip that kind of punctuates there in December. But as we've started the new year, we continue to see an uptrend in that. And so we're still down roughly 40% from a year ago, but we're moving in that right direction. As we now transition into market and economic related data, I thought I'd start with this chart. This is a U.S. Treasury expected break-even inflation rate, looking out over individual years in the blue columns from year 1 to 10 years out, and then on the far right-hand side, you've got the essentially the orange bars looking at 10, 20, and 30-year long-term break-evens. And for all of the conversation we've had lately about inflation building in the pipeline, which I think is very important, I think what this chart kind of tells you, and this is data that's gleaned from TIPS rates, which are Treasury inflation protected securities, which are publicly traded inflation protected bonds. And so this break-even rate is essentially the difference between what a Treasury would trade for of equal maturity on the market, like a 10-year Treasury, if you will, and then what a TIPS would trade for in terms of yield. And so this is the differential between those two. But what's interesting here is, like I said, with all the conversation we've had lately about inflation building in the pipeline, I think it's reflected in that 1 year forward number, which is about 2.85%. But interestingly enough, as you get into the out years, that number begins to go down, and it really coalesces around that 2.2, 2.25% range, which, if you think back, even 30, 40 years, that number looked a little bit more like 3%. And so this long-term go forward inflation is really going to be a little bit more around 2, maybe 2.25, call it. And this does have implications for financial planning decisions and in terms of gauging the purchasing power of each incremental dollar of savings and or investment. And I think it's really telling here that that number migrates down over time, and that the viewpoint in this data is that the inflation is really going to be more or less a interim term issue before it goes back down. It's another chart that I got from FS Investments, which I thought was really interesting, and it's a plot of inflation expectations against real rates. And we know that with inflation expectations beginning to build, and we've seen this is a data series that only goes back essentially a little bit less than a year. But as inflation expectations have begun to build, as producer prices and commodity prices, these are all inputs into the production mechanism. continue to go a little bit higher, the feeling is that producers are going to have to pass those along to the end consumer or the end purchaser. But in response, you can see that with interest rates moving higher and inflation expectations moving higher a little bit, we've seen a faster move in rates than we have in inflation expectations. So you can see that that negative real rate is really been offset here by the rise in 10-year interest rates, 10-year Treasury rates rather. So whereas we were at best a negative 1% real rate at the beginning of the year, now we're down about to a negative 60 basis point or 0.6% negative interest rate, and that number is continuing to move higher. And so when you think about the implications for negative real rates, obviously it's a disincentive, if you will, for a lot of types of investments, and it pushes people into gold and into some other things. But as that negative rate has decreased, it's taken a lot of the steam out of things like gold and into more inflation sensitive assets. Here's a couple of manifestations of that last chart in which we showed you the rise in inflation. These are a couple of things a few things rather, that I think are worth noting lately. But plastic prices and PVC, polypropylene, these are input costs into plastics, which we see in just about every facet of our daily life. And I think it's noteworthy here. We're getting some of this initial data back, if you will, from the impacts of the storms and some of the production facilities along the coast. They were taking basically distillates from crude oil and making these PVC and polypropylene based products, and you can see prices are really moving higher here. And if you think about all the things that are made of plastic in our lives, and these are input costs into those products, I think it's fair to say that we could see a little bit of price pressure in plastics here over the coming months, and in no small part due to the disruptions that we saw last month weather-wise. Now, on the right-hand side, we have other inputs, and these are more food related prices. These are futures for lean hogs, soybeans, and those are all moving higher. And so again, you've got a lot of different kinds of pressure that's building in the channel that we're going to have to pay attention to. And these charts tend to want to sound the alarm bell. I don't know that that's going to be the case, because I still think that there's a reasonably limited amount of pricing power that a lot of producers have because of some substitutability and things like that. But we're seeing enough of a move in some of these prices. And last week, I think we showed you steel and lumber prices, which are going much higher, that at some point those build in the channel, and you just can't suppress them by as a producer taking lower margins. You have to pass them along because then at some point it becomes a bit more of an existential threat as for you as a producer to absorb those higher costs without passing them along. Some more information on inflation, which I think is kind of the topic du jour these days. Got two charts here. Both are actually byproducts of Bank of America global research. And the first one on the left is a fund manager survey, which I find really interesting because as a fund manager or as an investment manager, I certainly spend a lot of time with the data, and I feel very strongly about inflation expectations beginning to build in the pipeline. And that seems to be viewpoint seems to be vindicated here by the consensus of fund managers, which do expect higher global consumer prices going forward. In fact, the net percentage of those, this is a bit of a diffusion index, so the net percentage of those, which is now at an all-time high and sits probably around 85, 80%. And again, if you go back to 2004, that's the last time that, 2004, we saw it a little bit in 17 and 18. We didn't see that inflation though, which was really ironic, but certainly had expectations that inflation was going to build. And that was around the time a couple of years ago when we started to see the Fed moving interest rates higher. But now is interesting because we're at an all-time high on inflation expectations, and yet we're still anchored at essentially 0% interest rates on the short end of the Treasury curve. Now, as you transition over to the right, we have essentially a mention. This is just kind of a summary of transcripts of earnings calls, and B of A, and there's some other people that do a really good job of this. They run an algorithm against these transcripts to pull out the number of mentions where executives on their earnings calls have talked about inflation, and you can see that that number is moving a lot higher. Again, this is another diffusion index, so the net percentage of those mentions of inflation really are moving higher. But at the same time, in that kind of that light blue bar, you see the actual CPI, consumer price index year over year, and it remains fairly muted. So this whole notion that inflation has to move higher, on a chart like this where you're plotting mentions of inflation to what actually happens with inflation, I think is kind of interesting because it's not a perfect correlation, as you can tell, but it is a reasonably positive relationship here. And so what this would imply just on this basis alone is that inflation's going to move higher. So this chart basically combines both the fund manager expectations of inflation moving higher with company management. These are the people that are making the stuff that are also in belief that inflation will move higher. And I think, if you have those two working in concert, I think you will ultimately see that manifestation in that light blue bar, treading higher. All right, transitioning over to some stimulus related things. We are on the heels of the $1.9 trillion stimulus package having been signed into law. And I thought I'd take a step back, and for all the comparisons that we've made in this last recession to the one before it, which happened in 2008, 2009, and what was the government response? What was the fiscal policy response back then? And Strategist does a really interesting job here of making that comparison. So in 2008, we had again, basically that was the election year, and most of these really kind of the anxiety peak was kind of in that August, September timeframe when Lehman Brothers failed and AIG had to be taken over, and Fannie Mae, Freddie Mac back in September of 2008. So that year we saw enough fiscal stimulus to equal about 1.1% of GDP, and whereas last year that was basically 10%. And then in 2009, we had follow-on stimulus of roughly, call it almost 7% of GDP. And this year, with the follow-on to the CARES Act, we actually are expecting an increase in in the amount of stimulus relative to GDP of perhaps 11%. And not all of the 1.9 trillion is expected to be spent in 2021. So we're going to have some follow-on effects, which are, in that next bar there. So, in 2010, that stimulus was 2.6, whereas in 2022, the remaining amounts are expected to be spent from this most recent stimulus bill, which will equal about 1.7% of GDP. So a clear indication here that what we are getting in terms of stimulus is far and above anything that we saw back in the global financial crisis. This is a little bit more of a near-term view of GDP, kind of as it sits today. And So this is from Strategis again. It's kind of a synopsis of both their feelings as well as kind of a summary of opinion out there. And I think this is pretty consistent with a lot of the large investment banks that have research houses and some other reports that I've read of GDP expectations. Again, the numbers aren't exactly the same, but I think they, they're similar in how they lay out. So essentially, we're looking here at the right hand side of this. So we know we've obviously had contraction um, in the pandemic, and we had a couple of negative quarters as we were struggling with shutdowns and lockdowns and things like that. And so, we're expecting essentially when it's all said and done, and we'll get the first basically run at first quarter GDP at the end of next month, April. And that's expected to be positive. But when we begin to really see the influence of the latest fiscal stimulus, and we're expecting a pretty strong second quarter number. And then essentially a strong follow through in the third and fourth quarter. And then as we have long noted in these charts of the weeks and in our sister webcast, the market minutes, that we do expect growth to kind of attenuate over a longer period of time. And that's shown here basically in 2022 that we're getting more like 2.5% growth. But in any case, near term, the latest stimulus package is definitely going to help the economy. And I think the chief worry right now is, frankly, whether there's too much stimulus in the system and whether that's going to cause the economy to overheat. And then the one thing that we don't want to see is that unexpected burst of inflation. Well, as a follow-on to the previous slide about more short-term economic growth, this is something that I thought was really interesting in the data in the reading pack this past week, and it really highlights this issue that we've talked about before about the last recovery. Even though it was the longest expansion on record, it was perhaps one of the most unloved, and the reason is really manifested in this chart, and because the growth rate in the economy that we saw was a lot lower than we've seen in prior recoveries and prior expansion cycles. And that's very clear here. So we took that hit in the global financial crisis and we had kind of a step back in economic growth. We were never able to kind of recover this trend line that has been well established over decades. And so, we were experiencing lower than expected growth again through all of the ups and downs and taper tantrums and expansions, and then we had the Tax Relief Act in 2017 that Trump put forward, and so none of that really got us back to this trend line, which is referenced in this 3.1% growth rate line in red. And then of course we had the pandemic, and so that set us back. And so from a I guess a delta or difference standpoint, I mean, we're far below that trend line. It's been well established basically for as long as I've been alive, and so we've got a large amount. We would be asking a lot of the economy to get back up to this trend line, and I don't think we will. But I think we're establishing a kind of a new leg or new branch of this growth, which I think, again, for capital budgeting decisions, for financial planning decisions and things like that, I think we're, going to have to, and especially as that last slide kind of seemed to indicate that we're going to begin to migrate in 2022 and 2023 into more of kind of a 2.5% growth rate, as opposed to the 3.1% that's referenced here. I think that's kind of what we need to be planning for as far as economic growth. And that's got implications for expected returns for a wide variety of investment assets. The chart on personal savings, I don't think it's any surprise to a lot of folks that we've seen a huge surge in this, and we've talked about it, and we've shown other charts along these lines. This is from the BEA, or Bureau of Economic Analysis. It's a federal office, and essentially it kind of highlights the impacts of the fiscal stimulus and the fact that we've seen a lot of people actually just bank the stimulus instead of spend it, which is essentially what we want them to do. But the good news here is, as we've talked about many, many times ago in both webcasts, that there's a lot of dry powder on the sidelines, and consumers tend to consume when they feel more comfortable about doing it. And we feel like that environment is going to exist in the second half of the year. So there's certainly a lot of dry powder and wherewithal to provide follow-on growth right now. We're with the latest stimulus package, we expect another spike in savings coming out of that, even though the latest round of stimulus was a bit more targeted. So the higher income folks that were the ones primarily responsible for saving their stimulus, more of the stimulus is going to the lower socioeconomic groups. And so where maybe the bump won't be as profound, as pronounced as we see here from the CARES Act, but nevertheless should be a further bump and more seed corn to eventually, hopefully, get plowed back into the economy. Talk about unemployment. We've had different varying levels of optimism with regard to economic growth. We know the Fed is going to be spending a lot of time scouring the socioeconomic layers because they're very concerned about minority employment, not just overall, but getting into the social layers and making sure that all levels of the labor pool are benefiting from the recovery. And as we continue to make progress here, which is very evident, obviously there's a big gap still expected. And looking at the latest round of Fed expectations, they actually do expect us to migrate back down to maybe 3.5% unemployment over the next several years. I think the slog, the heavy lifting on recovering from that forced shutdown environment, which is a huge spike on this chart, that the bulk of that heavy lifting or the recovery has taken place. Now we see the impact of small businesses that are struggling and trying to come up with a confidence to be able to expand their labor resources. And they want more confirmation that we're going to be opening, that the economy is going to continue to recover. They need that confidence to be able to go out and hire staffs. And so I think the path going forward is going to be a bit flatter than it has been over the last year. And I would agree with the assessment that it's going to take us several years to fully recover that labor number to get back down to that historic unemployment rate. Quick comment on housing, and we've got a couple of things here on housing to show you. Again, the sentiment remains high, perhaps not on its peak, but home builder optimism remains really strong. Single family sales are actually really strong, but we know that we're at a extreme disadvantage in certain markets, including our own local market here in Central Texas. We've just seen a tremendous amount of net migration, and essentially all new supply coming onto the market is just satisfying that incremental demand as people are relocating here and such. It's not satisfying the growth per se of new homeowners that are entering the markets, the millennials, and then now essentially the kind of the Gen Z crowd that are old enough to begin to think about buying a starter home and things like that. We just don't have that inventory. And so, this is one of the areas where owner's equivalent rent, OER, is a component of CPI, consumer prices. And, I would think that number is going to continue to move higher based on the strength of this type of data that we're looking at here. This is another chart actually from Mizuho Securities and kind of incorporates some Census Bureau data. But as you can see here in the green line, our housing starts month over month, as you look over the last several months, has actually declined. Now, some of this again goes back in February. The delta between January and February is in fact seasonal. That over the country you have weather issues and whatnot, and you tend not to produce as many houses. But I think February was clearly influenced by the adverse weather across many parts of the country. But this is something else that kind of feeds into this theory that that we're going to see more upward pressure on housing prices because of the stock of houses not keeping up. And you can see here that the forecast range, the starts number for February was actually below the forecast range, and well below market expectations as well. So I think we'll continue to keep tabs on the housing market and certainly on housing prices moving forward. Well, and yet another sign of a tight housing market, we see data here from Redfin, which indicates that we are in extraordinarily rarefied territory in terms of we've essentially 63% of home buyers actually made offers sight unseen. So, if you assume that we've had lockdowns and pandemic related things where people can't, maybe a little less interested in doing on-site viewings and doing more virtual screenings and whatnot. But what's really interesting is this number shows that we've had a record high level of home buyers that are making offers without even looking at the property. Here's some freight data, which kind of corroborates this view that we are in a kind of a global expansion. This is the Baltic Dry Index, which is just a signpost for what global trade looks like. And we know we've seen some suppression in overall global trade, and we've expected with the synchronized global recovery that would begin to pick up. And this chart clearly tells us that that is the case. Copper and gold are going in different directions, and we've talked about this a little bit with regard to the decline or the increase in real rates from their -1% to -0.6%. And that's actually had an adverse impact on gold. We've seen a reasonable amount of kind of disintermediation, if you will, but gold is not as strong an asset class right now as it was last year, where at the same time, copper, which is more of an industrial metal, and we know we've seen steel and we've seen some of these other industrial metals over the last several weeks continue to move higher. So we know construction, we know electronics and things like that, which all demand copper wiring and such, is going to continue to place a bid underneath copper at the same time that gold, I think, is going to find a trough here and just kind of settle in at this lower level. Retail sales are worth taking a look at here and getting kind of a quick check back. So, where we've seen the best activity has clearly been in food and beverage overall. Total sales are now tracking above where they were. We had seen that recovery. We know we've got a lot of online sales that are doing well. The clothing industry and apparel continues to lag, as does gasoline is almost made up its entire loss as we have more mobility now and those types of things. But we'll continue to monitor food service and drinking places on this chart, aka bars. Those numbers will continue to improve as we get more reopenings in some of these jurisdictions like Mississippi and Texas that are kind of taking a lot of these restrictions off and opening to 100%. Here we have some economic sentiment indicators from HPS Insight, which are actually quite favorable. When you think about the consumer representing about 2/3 to 70% of the total economy, it's really important that we have strong sentiment that ultimately translates into consumption. And so with all of these charts here and all these different lines representing major purchases, personal finances, feelings on the economy, jobs, et cetera, that overall sentiment index continues to kind of accelerate here in the new year, which is really positive, I think, especially for the second half of the year. As we transition from economics into the market a little bit, here's the S&P 500 trailing 12-month price to earnings ratio, which is off of its high. It's still 28.6 times, which is much higher than the 16.3 times average that we've seen dating back all the way to 1950. But this is all very cyclical. You can see that that you tend to see higher multiples when you emerge from recessions, right? Because you've had your earnings trough at the same time. Maybe prices haven't reacted, or in this case, prices are anticipating that surge in earnings, which I think we'll begin to see later this year. And so, not unlike what we saw in the tech bubble in the late 1990s, and then in the eve and during the interim of the global financial crisis, we see these high multiples, and I think there are some arguments to be made that yes, they're frothy and that we're due for a pullback. There are other arguments that are there that say that we've got low interest rates, which typically harbor a higher multiple anyway. But I think all of those are valid, but just a good head check here that at least these multiples are off their peaks. So this is Evercore ISI, a large research firm out of New York. This is their outlook, and I think a few things I want to point out here is, and this is very consistent with some of the information we've shown in previous charts, but the nominal GDP. This is the inflation, the economic growth number. 2021 is expected to be 10.7%. That is outsized growth. 2022, 5.7, which is still outsized, certainly relative to what we've seen. And again, even if we transition back to like maybe more of a 2.5% annual growth rate, these next 2 full fiscal years are expected to be fairly strong. And if you look at the 10-year bond yield in the middle of this chart, expecting perhaps 2% by the end of this year, and so that's moved up 50 basis points from where we started this year, and then next year adding another 50 basis points to get to about 2.5%, which I think will be a little bit closer to normalized. I think it'll be a little bit closer to inflation, which you can see in the core PCE, or personal consumption expenditures deflator. So as we get from this low inflation environment, we move to a higher inflation environment, but certainly not high relative to where we were like 30, 40 years ago, like I said. But then you have a 10-year Treasury yield that kind of mimics that. That's what you want to see. It's a very healthy environment. And you can see the unemployment rate, labor pool getting down there. So you got prices and labor, which is essentially the Fed's dual mandate, both kind of aligning. So we're in a really kind of a good spot by the time we get to the end of next year. Weekly equity fund flows continue to be real strong, and this has been a sore spot for equities for many, many years. But the good news is that we've seen a lot of support in equities. We've seen a lot of money flow into the equity market, and it is helping to bid up prices. But I think it's also healthy from a sentiment standpoint. Here is our U.S. 10-year Treasury, and you can see here that, and we've even seen, rates now. This chart is actually dated the way we've been trending lately, but we're essentially back up to where we were pre-pandemic in terms of Treasury yields, which is an outstanding move. But you can see that we've retraced that total gap. Now, granted that rates were coming down in 2019, but we're back up at least to where we were pre-pandemic. So it's important to realize, though, that with Treasury yields moving decidedly higher, I think higher than we would have expected, certainly at this point of the year, that's had a profound impact on the valuations of fixed income. And so this represents essentially the third largest drawdown in U.S. Treasuries, and this is measured in terms of prices. So this is like a price drop for 15 plus year treasuries. Those long dated treasuries have really taken it on the chin this year, because as yields move higher, prices move lower. And so it's been a really tough year for long-term bondholders, where, in years past, and certainly last year, it was a banner year for bondholders, especially of longer dated maturities. Here's a symptom that our yield curve is increasing, and fairly dramatically. So, as recently as the end of the year, that was maybe 60 basis points, and now it's over 1.5%. So essentially, we've seen a doubling in the spread. Now, this is taking the 10-year Treasury yield and subtracting the 2-year Treasury yield. And so the difference right now is over 1.5%. And as you can see here, that's moved rather quickly from a trough that we actually saw back in 2019. In fact, we actually had a negative sloping yield curve for a brief period of time back in 2019. But this is healthy for a lot of different reasons. It's very good for the financial services industry, and other financial related entities that use spread-based lending. So they're able to achieve a higher return on assets essentially. So and it's also good from a saver's standpoint. Now, these are people that have long-term savings, especially people, from a financial planning perspective, that can dollar cost average savings into the market. And this is a very good thing for them. So this is a survey of Bank of America on what level would the 10-year Treasury have to be at before we saw a 10% correction in the equity market. And this is something that I have pondered and thought about quite a bit, because I know there is a level at which there's going to be pressure on the equity markets, and we just don't want to see the yields move too fast too soon. An orderly increase like we've seen is healthy. It's a symptom of rates are moving higher for all the right reasons. The economy is expanding, et cetera. But this chart shows you that basically 2% is kind of that level which we need to be aware of, that could put some interim pressure on equities. Now we'll talk for a second about the U.S. dollar, and this chart actually does a plot of the U.S. twin deficits, which are essentially budget and trade deficits in terms of percent of GDP, and they plot that against the trade-weighted dollar. This is lagged 2 years, so you kind of have to, basically they're showing the lagged impact of those twin deficits, and so what we've seen over the last year is we've seen huge fiscal deficits, and we've also seen some trade related deficits as well. But in this case, given that there's a reasonable relationship here on at least on a lag basis with trade overall deficits in the dollar, that one would expect the dollar to weaken moving forward, and so this has implications insofar as, like, say, commodities, crude prices, things like that are concerned. It obviously has an impact on trade competitiveness. If our dollar decreases, then our exports are more competitive in the global marketplace, which would help, exporting firms, which, non-U.S. revenues account for, anywhere between 30 and 40% of the S&P 500 earnings. So a weaker dollar here is suggested by this data on a lagged basis, and that is actually a positive for stocks in a lot of different ways. Our last chart of this week actually focuses on the impact of the pandemic on attitudes related to working from home, and the fact that a lot of people working from home obviously don't have commute times and things like that. And so I thought it'd be interesting to kind of examine, what the sentiment and future of work looks like. There's a lot that's now being assembled and written. A lot of real-time analyses are being done to try to help people forecast building occupancy and things like that. So we're learning more about what people are able to do without having to sit in a car or in a bus or train to get to work. And frankly, they're being more productive. They're getting more work done on their primary job, which is evidenced in the left-hand side. And they're also increasing their leisure time. So there's a quality of life thing as well, and getting some home improvement things done. So, and you can see childcare, which is not tops on the list, but I know for a lot of two-wage earners with kids at home where there's distance learning and the kids aren't in schools, that's a huge burden. And so, that certainly registers here, but you can see that there's, the working on the primary job, that a productivity enhancer to not be on the roads, I think is something that I think a lot of employers are paying attention to right now and certainly will pay attention to in the future. And then on the right-hand side, you can actually see that, we've got, about 23, call it almost a quarter of the working population that are either sometimes or always working remotely, and that if given the choice, they would continue to do so, even if the economy fully reopens and schools reopen and things like that. So I think this has some interesting implications on what productivity might look like. And again, productivity is a lever which helps to keep inflation in check overall. And sometimes productivity is hard to measure, but in this case, it could have some meaningful impacts on helping to dampen long-term inflation. Not just next year, but maybe as we look farther out into this new decade. That's all we have this week. I appreciate you spending the time with us. Hope you've enjoyed the presentation on behalf of all of my colleagues at BKA. We appreciate your interest and support of our research and activities. Feel free to reach out to me at the information you see on your screen. Hope you have a wonderful week, a safe week, and a productive week. And we look forward to seeing you again soon.